the world of finance, it's way more dynamic than just watching companies sort of passively grow or shrink along with the economy. Forget that simple picture for a moment. If you look closer, there's this really complex, sometimes chaotic, but honestly incredibly fascinating universe. It's where sophisticated investors are looking to profit not just from steady growth, but from specific, often disruptive things happening to companies. Imagine finding these hidden opportunities, right in the middle of mergers, big restructurings, bankruptcies, activist fights, or even tangled legal battles. This deep dive, it's your guide to navigating that exact landscape.
That's really the core idea, isn't it? It's a different way of thinking compared to, say, traditional long-term investing or even macro trading. You're not just looking at a company's general health or broader economic trends. No, you're laser focused on specific discrete events you believe will act as powerful catalysts to unlock value, reveal hidden value, or maybe fundamentally change how a company's securities are priced. These are the kinds of opportunities the wider market might be overlooking or mispricing at that particular moment.
Okay, and that brings us right to the heart of this deep dive. We're unpacking the whole world of event-driven investing and related complex strategies. And we're going way beyond that classic example of just betting on whether a simple merger deal closes. We're going to dig into how savvy investors actually identify these value catalysts, the intricate ways they structure trades around them, the specific, often pretty unique risks involved, and how these strategies mostly play out in the U.S. market. We've got a stack of sources here, research covering everything from hedge fund playbooks, the gritty details of distressed debt, to the, less obvious and sometimes pretty controversial world of litigation finance. Our mission here is to pull out the most important insights from all this, distill that core knowledge, and help you understand what really makes these strategies tick, what the sophisticated players are looking at, and, frankly, why it matters.
Right. At its most fundamental level, event-driven investing is really all about exploiting pricing inefficiencies in the market. But critically, these aren't just random blips on the screen. They're inefficiencies directly caused by specific, definable corporate events or actions that are anticipated. Think of it like dropping a pebble in a pond. It creates ripples. A merger gets announced. A company files for bankruptcy protection. An activist shareholder starts making noise. A big regulatory decision is coming up. Each of these creates a situation where the market price of a company's stock or its bonds or other securities doesn't yet fully reflect the probable outcome or the likely post-event value. There's a gap, a temporary discount or premium that the event-driven investor is trying to capture.
Okay, so it's not about predicting if the S&P 500 goes up 10% next year. It's much more specific. It's about identifying that particular moment or that process for one company and betting on how its securities will be repriced because of that specific thing. You need a different take on what's going to happen.
Precisely. You're finding these mispriced securities because you have a distinct, often you hope more informed view of those potential value unlocking catalysts. You need a sharper assessment of the probability, the real chances of the event actually happening as planned, and a more accurate prediction of what the company or its securities will be worth after the dust settles. The success here really hinges on predicting these outcomes accurately and, this is absolutely crucial, understanding and managing the often complex and unique risks tied to that specific event. These aren't your typical market risks, they're event-specific risks.
Got it. It's about the individual story, the narrative playing out around one company, driven by a specific event. Now, our sources make it crystal clear that event-driven isn't just one thing. It's a big umbrella term. It covers several distinct approaches, often used by sophisticated investors like hedge funds. Let's unpack some of the key ones. Maybe start with one that flips the script a bit by actually creating the events. Activist investing.
Yes, activist investing is a powerful and quite distinct form of event-driven strategy. It's distinct because the investors aren't just passive observers waiting for news. They are actively trying to create the catalyst they believe will boost shareholder value. This usually means taking significant stakes in companies, often big enough to make them a major influential voice, specifically to influence management decisions, strategy, you name it.
So they're not just buying shares, they're buying a seat at the table, or at least trying to, pushing for big changes like selling off parts of the business, changing the debt structure, spinning off assets, maybe even shaking up the board or CEO.
Exactly. The underlying philosophy is usually deeply rooted in value investing. It starts with intense, fundamental analysis to figure out where value is perceived to be trapped or maybe mismanaged. Then they take a proactive approach, sometimes behind closed doors, sometimes very publicly, sometimes aggressively to persuade or pressure the board and management to adopt strategies or actions they think will unlock that value for everyone. This can involve quiet chats, public letters, proxy fights to elect new directors, or even, sometimes, litigation.
That proactive approach sounds like it can generate some serious headlines. And within activism, our sources point to a particularly, let's say, sharp-edged subset, activist short sellers. This sounds like it kicks up even more dust.
Oh, it absolutely does. Activist short sellers mix short selling with an activist campaign. Their goal is to profit from a big drop they expect in a company's stock price. But unlike a typical short seller who just takes a position based on their analysis, activist short sellers conduct really deep investigative research, often looking for things like accounting irregularities, alleged fraud, misleading company statements, or business models they think are just unsustainable. Then, crucially, they publicize this research widely.
So they're not just betting on a price drop, they're actively trying to trigger that drop by bringing these alleged flaws out into the open.
That's the core of the strategy. It relies on their research being credible and hitting hard enough to convince a chunk of the market that the company's valuation is fundamentally wrong, or maybe even based on deception. If they're successful, the resulting loss of confidence can cause a sharp stock price decline. That lets the activist short seller cover their short position, buy back the shares they borrowed at a much lower price, pocketing the difference.
That definitely sounds like something that targeted companies would call market manipulation. How does that square legally, especially in the US?
It very frequently faces accusations of manipulation, no doubt about it. But the advocates for activist short selling argue it actually plays a vital role in the market, almost like an independent watchdog. They argue it boosts market efficiency by exposing potential fraud or bad practices, which ultimately protects other investors and leads to better transparency and more accurate stock prices. In the U.S., the general view from regulators and courts, according to our sources, is that this isn't illegal manipulation as long as a few key conditions are met. They can't disseminate information they know is false. They generally can't charge others for their research, which might look like paying for influence. And they need to be acting in their investors' best interests by trying to profit from what they genuinely believe, based on truthful information, is an overvaluation. The key, as highlighted, is the truthfulness and integrity of the information they put out there.
That truthfulness part is absolutely critical. Can you give us a concrete, well-known example of an activist campaign?
A prominent one mentioned in the sources is Elliott Investment Management's campaign targeting Twitter back in 2020. Elliott is a very large, very well-known activist fund. They disclosed a pretty significant stake, sources say around 4% of Twitter, making them one of the biggest shareholders at the time.
Okay, so they bought enough shares to get leverage. What were they pushing for?
Their publicly stated goal was to push for changes they thought would enhance shareholder value. A big sticking point was the then CEO Jack Dorsey's dual role. He was CEO of both Twitter and the payments company Square. Elliott argued this split focus meant Dorsey couldn't give Twitter the attention it needed, and that wasn't best for the company long term.
How did Elliott actually try to achieve that? What were their tactics?
Well, they initially engaged privately with Twitter's board and management, trying to negotiate. When that didn't fully achieve their aims, they ramped things up. They advocated publicly for operational improvements, and crucially, they nominated directors to Twitter's board people they felt would better represent shareholder interests. That created significant pressure and a lot of media attention.
And what happened in the end? Did they get what they wanted?
Well, Elliott didn't force an immediate sale or anything like that, but the campaign definitely led to significant governance changes. Twitter made a deal with Elliott. That deal included changes to the board and its structure. While Dorsey stayed on as CEO initially, the pressure was certainly a factor in the environment that eventually led to him stepping down as Twitter CEO in late 2021 to focus just on Square, which is now Block. So it was widely viewed as a partial but still significant success for Elliott, aligning with their goals for better governance and focus at Twitter. It's a classic example of an activist creating an event through sustained pressure. Thinking about the broader market context for activism, it's typically tougher in strong bull markets, when stock prices are generally rising. When the whole market's going up and shareholders are happy with returns, they're usually less interested in hearing calls for disruptive changes or challenging the leadership, even if the activist has a solid value argument. Makes sense. Why rock the boat if the stock's doing well, right? Exactly. Conversely, the opportunities for activism often look better during times of corporate distress or underperformance. A company struggling financially or making strategic mistakes might have a board and management team more open, maybe under duress, to considering big changes pushed by a large shareholder. Also, Sectors going through rapid change or disruption, think tech during platform shifts, or healthcare facing big regulatory changes, often present more chances for activists. They can argue for strategic pivots or changes in how capital is used, more so than in, say, stable, slow-moving industries like utilities. Activists are looking for situations where they think they can genuinely make a difference.
Okay, so activism is about proactively forcing change. Let's shift gears to maybe the most well-known type of event-driven strategy. It's more reactive to events already announced, but still pretty complex. Merger arbitrage. Let's go beyond the basic definition. What are the sophisticated players focused on here?
Right. The basic idea of merger arbitrage, or ARB, is pretty straightforward. You specialize in capturing the spread between a target company's current stock price and the price agreed upon in an acquisition after that deal is announced publicly. The standard trade is to buy shares of the target company, which are usually trading below the deal price, expecting to sell them when the deal finally closes at that higher agreed price.
Seems simple enough. Buy low, wait, get paid the higher price when it closes. But what does that spread actually represent to the arbitrager? What info is packed into that price gap?
That spread is absolutely key. It's much more than just a simple price difference. It really represents the market's collective judgment on the perceived risk and the expected timing of the deal successfully closing. A wider spread generally means the market sees a higher risk that the deal might not go through as planned, or maybe it thinks it will take a long time to close. So investors need more compensation for tying up their capital. A narrower spread suggests higher confidence that the deal will close, and probably sooner rather than later. There are several really important factors that influence how wide that spread is. The biggest one is the risk of deal completion itself. Will they get regulatory approval? Are there major antitrust issues? Will shareholders vote yes? Are there financing conditions? Any potential roadblock increases this perceived risk and widens the spread. Then there's the time value of money. Capital is locked up until the deal closes, right? So the spread includes a premium for that opportunity cost. A longer expected closing time means a wider spread. And of course, interest rates play a big role here. Higher rates mean a higher cost of capital, which generally pushes spreads wider too.
And what about just general market mood? Does that affect it?
Market sentiment and volatility definitely play a part. More volatility or just negative sentiment, whether it's about the deal itself, the sector, or the whole market, can widen the spread because it just adds uncertainty. Also, speculation about competitive bids or potential changes to the deal terms can really swing the spread. If the market starts thinking another company might jump in with a higher offer, the target stock price might surge closer to or even above the initial offer price. That's called trading through the terms. Arbitragers are constantly watching for signs of bidding war or revised terms. And finally, this is a subtle but really critical point our sources mention. Arbitrager demand and who's actually trading the stock significantly impact the price after the deal announcement. Once a deal is announced, many of the original, say, fundamental or growth investors in the target company often sell out. The main traders left in the stock are then the dedicated merger arbitragers. If lots of ARB funds are rushing to buy and capture the spread, that demand narrows it. If capital is flowing out of the strategy or there's less interest, the spread can widen.
Their collective activity really defines how the stock trades until the deal closes.
That's a key insight the players change after the announcement. How does the actual trade structure differ if it's a cash deal versus a stock deal?
In cash deals, it's relatively straightforward. The ARB buys the target company's stock. The profit comes from the market price rising to meet that fixed cash offer price. Simple enough. But in stock deals, where the acquiring company offers its own shares as payment, the structure gets more complex. It involves hedging. The ARB buys the target stock, yes, but they also simultaneously put on a corresponding short position in the acquirer's stock.
Why short the acquirer's stock? What does that achieve?
It's to hedge against swings in the acquirer's own share price. In a stock-for-stock deal, the value of what the target shareholders receive depends on an exchange ratio, how many acquirer shares they get for each target share. If the acquirer's stock price drops while the deal is pending, the value of the offer effectively shrinks. Shorting the acquirer's stock helps lock in the value of the spread based on that agreed ratio and minimizes the risk tied to how the acquirer's own stock performs. It's a bet purely on the deal closing, not on the acquirer's stock going up.
Fascinating. That sounds like something primarily done by big financial players. Was it always that way?
Historically, yeah, this was very much the territory of proprietary trading desks, the prop desks inside large investment banks. They had the capital, the expertise, the infrastructure for these complex hedge trades. However, after the financial crisis, regulations changed things, particularly the Volcker Rule in the U.S., that significantly limited prop trading activities within banks. As a result, the space for sophisticated merger arb has largely shifted over to dedicated hedge funds, or it's managed as a core strategy within larger multi-strategy funds.
And why is the U.S. market such a hub for this strategy compared to, say, Europe or Asia?
Our sources point to a few key reasons that make the U.S. particularly attractive. First, there's just a consistently high volume of M&A activity, which provides a steady flow of potential deals. Second, the regulatory environment, while definitely complex, is relatively transparent compared to many other places. And third, there's high market liquidity, which makes it easier to get in and out of positions efficiently. While there are certainly ARBs specializing in Europe or Asia, many global event-driven funds often have a significant weighting towards U.S. deals.
Is this strategy becoming purely quantitative now, driven by algorithms just spotting tiny spreads? Or is there still a big human judgment component?
There's definitely been a move towards more quantitative approaches, especially in identifying potential deals early and managing the hedges systematically. This has led some people to see it as becoming somewhat commoditized, almost like an alternative risk premium you can capture through rules. However, our sources really emphasize that despite these quantitative tools, the strategy remains significantly discretionary. Assessing the unique wrinkles of each deal, like the real likelihood of getting past specific regulators, the complexities of integrating the two companies, figuring out if the claimed synergies are real, that still takes a lot of human judgment, legal insight, and deep fundamental analysis. It's definitely not just a pure numbers game. It requires digging into the specifics of each deal.
Okay, let's look at a very recent, very high-profile example, Microsoft's acquisition of Activision Blizzard. How did merger arbs play that one?
Yes, that was a classic, although incredibly complex merger arb situation. The deal was announced way back in January 2022. Microsoft offered $95 per share in cash for Activision Blizzard, a massive $68.7 billion deal. Arbitragers jumped in almost immediately, buying Activision shares which were trading well below that $95 offer price. They were betting that the price would eventually converge to the offer price when the deal finally closed.
But that deal faced a huge amount of regulatory scrutiny, didn't it? More than usual.
Absolutely. That was the core risk and really the source of the arbitrage opportunity. The deal faced intense, prolonged antitrust reviews from regulators in the US, the EU, and the UK. Concerns about Microsoft's potential dominance in the gaming market and the impact on competition created massive uncertainty and made Activision Blizzard's stock price bounce around for months and months.
So that regulatory uncertainty kept the spread wide, reflecting the real risk the deal could get blocked. And that's what the ARBs were focused on analyzing.
Exactly. That wide spread was the direct compensation for taking on that significant regulatory risk. ARBs had to constantly monitor the review processes, the legal challenges regulators threw up, market rumors, official statements, constantly updating their odds of the deal actually getting over the line despite all the hurdles.
And after navigating all that, the deal did eventually close in October 2023.
It did. And that example really shows how complex regulatory hurdles aren't just risks to a deal. They are the very source of the opportunity and the spread for merger arbitrageurs. It highlights how managers need to be skilled not just at company analysis, but at navigating these intricate legal and regulatory processes and continuously reassessing the probability of completion.
It definitely shows it's far from a sure thing. How does merger arb generally perform in different market conditions? Does it always work?
Well, its performance really depends heavily on the overall level of M&A activity. The strategy tends to thrive when M&A volumes are high globally or in key sectors. That provides a bigger pool of opportunities and lets managers diversify across many different deals. Conversely, during economic downturns or periods of high uncertainty or big external shocks that just kill M&A appetite, the strategy faces headwinds. Fewer deals mean fewer opportunities, which can lead to crowding in the few attractive deals left, potentially compressing the spreads and making them less profitable.
What about interest rates? Seems like that would have a pretty direct impact.
Interest rates have this interesting kind of dual effect on merger arb. On one hand, yeah, higher rates increase borrowing costs for companies, which could potentially slow down M&A activity overall. However, higher rates also tend to contribute to wider spreads in the deals that do get announced. Why? Because investors demand a higher return, a bigger premium, to compensate for the opportunity cost of having their capital tied up while rates are high.
So maybe fewer deals overall, but potentially more profit, more juice in the deals that are happening.
Precisely. That's the trade-off. Lower interest rates tend to encourage more M&A volume, but often lead to tighter spreads because the cost of capital is lower. So The net impact on the strategy really depends on that balance between the number of opportunities and the profitability embedded in the spreads of those opportunities.
And regulatory or political scrutiny, like we saw with Microsoft Activision?
That has a huge and, it seems, growing impact. Antitrust reviews in the US, UK, and EU have definitely gotten more rigorous and seem to take longer. This stretches out the deal timelines, increases the chance of deals being blocked or needing major changes like selling off assets, and consequently, it leads to wider spreads to compensate investors for that higher risk. Geopolitical tensions, like between the US and China, can also complicate or even block cross-border deals, adding another layer of risk arbs have to factor in. We've seen examples in the past with deals involving companies like Xilinx AMD or Qualcomm Broadcom getting blocked over national security or competition concerns.
So even though it's focused on specific company events, these bigger market, economic, and political forces are constantly shaping the landscape and the risks. What about the overall risk-return profile? Does it just move with the stock market?
Generally speaking, merger arbitrage is considered market neutral, or at least having very low correlation, very low beta, to the broad equity markets. While a simple cash deal technically involves being long the target stock, the strategy's performance is mainly driven by the yes-no outcome of individual deals closing or breaking, not by whether the S&P 500 goes up or down. This means it tends to perform independently of typical market volatility or directional moves.
But it's not completely immune to major market stress, is it?
No, that's a key distinction. While it's usually uncorrelated with normal market swings, it is vulnerable to extreme market dislocations or systemic crises. In a real market panic or a severe economic shock, even deals that looked solid can fall apart because financing disappears, companies change their strategic minds, or regulators step in to stabilize things. Yeah. Plus, during sharp, broad market sell-offs, even if a deal is still likely to close, the mark-to-market losses on the ARB positions could force funds to de-risk and sell assets, which could actually make the price drops worse. So while it's market neutral most of the time, it carries this tail risk in really extreme scenarios.
Okay, insulated from normal market weather but exposed to hurricanes. Moving beyond just single M&A deals, our sources mention event multi-strategy and event opportunistic funds. How do these broaden the event-driven world?
Right, these fund structures take a more diversified, more flexible approach. Instead of just focusing on one thing like merger arb, they invest across multiple event-driven sub-strategies we've touched on. So merger arb, activism, distressed credit, various special situations. They might even allocate some capital to strategies related to market mechanics, like index rebalancing or equity capital market stuff.
So they're basically managing a portfolio of different kinds of event bets.
Yeah, that's a pretty good way to think about it. Multi-strategy funds are often set up with different portfolio managers or distinct teams focusing on specific event sub-strategies. The capital they allocate to each strategy is dynamic, it can be shifted around, but in a typical multi-strategy fund, these shifts tend to be less dramatic. The focus is more on managing risk across a diverse set of opportunities. The main goal is usually to deliver diversified returns with relatively low volatility by spreading the capital and maybe using moderate leverage. The returns are typically driven by the alpha, the specific skill generated from the outcomes of all the different events in their portfolio.
And the opportunistic flavor, how's that different?
Opportunistic event-driven funds have even more flexibility in how they allocate capital. They can shift the money around much more aggressively, much more quickly, based on where the managers see the most compelling opportunities at any given moment. This flexibility offers the potential for higher returns compared to a more structured multi-strategy fund. But it often comes with moderate to high volatility because the portfolio can become much more concentrated in just a few high-conviction event plays. Their risk-return profile is generally more variable than a diversified multi-strategy approach.
Got it. One spreads bets widely hoping for stable alpha. The other makes bigger, more flexible bets hoping for higher but potentially bumpier returns. You mentioned special situations as something these funds might invest in. These sound like even more niche, maybe more complex arbitrage plays.
They often are. These are usually sub-strategies tucked within multi-strategy or opportunistic funds. They focus on less common or maybe more technically intricate pricing inefficiencies that are driven by specific corporate structures or market events. Let's quickly run through a few types described in the sources.
Okay, first up, share class arbitrage.
This strategy looks for price discrepancies between different classes of shares issued by the same company. Sometimes companies issue, say, Class A and Class B shares with different voting rights or different dividend payments, maybe different tax implications. Occasionally, due to temporary supply-demand issues, liquidity differences, or investor preferences, these classes trade at prices that don't quite line up with their underlying economic value or the value implied by those different rights. The ARB might buy the cheaper class and maybe short the expensive one, betting that some corporate event or just market forces will eventually cause the prices to converge to reflect their true relative value. The risk, the price gap just stays there, or even gets wider, especially if there's no clear catalyst to force them together.
And dual-listed arbitrage, similar idea, different location.
Exactly. This targets price differences for the same company, but whose shares are listed on different stock exchanges in different countries. Theoretically, arbitrage should keep these prices aligned, but gaps can open up due to local supply and demand, currency fluctuations, different trading hours, local sentiment, or transaction costs. The strategy is to simultaneously buy the stock where it's cheaper and sell it where it's more expensive, capturing that difference. A big practical risk here is legging risk. You manage to execute the buy leg, but the price on the other exchange moves against you before you can complete the sell leg. That's especially tricky with different time zones or market holidays.
Okay, next, capital structure arbitrage.
This one's more sophisticated. It tries to exploit perceived mispricings in the relative valuation of different securities within the same company's capital structure, usually focusing on the relationship between its debt and its equity. An ARB might decide, for example, that the company's bonds look too cheap compared to its stock price, based on their view of the company's real value or the odds of something happening in the future, like a debt restructuring, a new stock offering, or a credit rating change. They might buy the bonds and short the stock, betting those relative prices will eventually converge. This needs deep analysis of both credit and equity, understanding how debt and equity values interact, especially as a company gets closer to financial trouble.
And holding company, or stub arbitrage, what's that about?
This focuses on companies that are basically holding companies. Their main assets are significant stakes in other separate publicly traded subsidiary companies. It looks for potential price gaps between the market value of the holding company itself and the combined market value of its publicly listed subsidiaries. Sometimes, the holding company trades at a discount to the sum of its parts, the classic holding company discount. The snub value is the part of the parent company's value that isn't accounted for by its listed assets, maybe unlisted operations, corporate costs, or just a conglomerate discount. ARBs look for situations where this implied stub value seems wrong. They might short the holding company and buy the underlying subsidiaries, betting that some event like a spin-off, an asset sale, a divestiture will unlock that trapped value and force the holding company's price to better reflect the value of what it owns. These strategies really show how event-driven investors are looking beyond just simple merger announcements for opportunities created by structural or temporary market glitches.
They definitely sound more technical, more specialized. What about opportunities created by how companies actually raise money in the public markets? You mentioned equity capital markets or ECM.
Right. ECM strategies focus on events related to issuing and trading stocks, things like initial public offerings, IPOs, follow-on offerings when a public company sells more shares, or big block trades, private sales of large chunks of stock, usually at a discount. These events often create short-term price movements and potential inefficiencies that event-driven funds try to capitalize on.
How exactly do funds play these kinds of events?
Well, hedge funds and other sophisticated investors can try to generate alpha from ECM events in a few ways. They might get allocations in hot IPOs, which sometimes trade up immediately after pricing. That requires good relationships with the banks underwriting the deals. They can participate in secondary offerings, often buying shares at a slight discount to the market price. They might do block trades, buying big positions directly from sellers at a negotiated discount. Our sources also note that some funds will actually short a stock before they expect a secondary offering or block trade is announced. They're betting that the increased supply of shares, dilution, or the overhang from a big seller will push the price down, letting them cover their short at a profit. This requires really good intel and market timing.
Sounds like success there really depends on relationships and getting the timing right. Is this a strategy that works consistently?
It's highly cyclical. These strategies can do really well, generating strong, uncorrelated returns when capital markets are buzzing lots of IPOs, follow-ons, block trades happening. But they tend to struggle when markets are quiet, or during downturns when that deal flow just dries up.
Yeah.
No events, no opportunities.
Okay, so we've covered events driven by corporate actions, special structures, market mechanics. What about companies in serious financial trouble? Investing in distressed debt sounds like a whole different ballgame, different risks, different skills needed.
It is a major and often very complex part of the event-driven world. Distressed debt investing means buying securities, usually bonds or loans, in companies that are already in or very likely headed for bankruptcy, debt restructuring, reorganization, or even liquidation. These are companies in deep financial distress, where the total claims against them are worth more than the company itself seems to be.
So you're basically buying the IOUs of a struggling company, often at pennies on the dollar because the risk of not getting paid back is so high.
Exactly. Investors buy these bonds, loans, or other debt instruments that are trading way below their face value because the company's future looks so uncertain. By acquiring these securities at a steep discount, these investors often become major creditors. And importantly, this can position them to exert significant influence, maybe even gain control during the complex restructuring process that follows.
How do they actually make money in the end?
Well, the gains come when the distress is resolved, either during or after the process. This can happen in several ways. Maybe they sell the restructured debt securities they received. Maybe they get newly issued stock or debt in the reorganized company in exchange for their old claims. Or maybe the securities they held just appreciate in value as the company successfully emerges from trouble and starts to recover.
Is this a market most investors can access? Or is it pretty specialized?
No, it's largely dominated by dedicated distressed debt hedge funds, distressed private equity funds, and the distressed desks within large multi-strategy funds. The sources highlight that big traditional institutional investors, like pension funds or mutual funds, are often actually restricted by their rules from owning defaulted or deeply distressed debt. This limits the number of potential buyers and makes the demand for these securities relatively inelastic, which can create opportunities for those specialized funds that do have the expertise to analyze and navigate these situations.
And our sources specifically mentioned the U.S. insolvency system, particularly Chapter 11, as being quite helpful for distressed investors. How does the U.S. legal setup facilitate this?
The structure of Chapter 11 bankruptcy in the U.S. is really designed with goals that can help sophisticated investors extract value. Its main aims are to trade and rehabilitate viable businesses while maximizing the returns for creditors. It provides a framework for getting new money into the company, like debtor in possession or DIP loans, which get super priority status, and it gives the company time and legal protection to negotiate and implement a reorganization plan. The whole process is quite structured and relatively transparent, which benefits creditors who understand how to work within that system.
And creditors have specific rights under Chapter 11 that give them leverage.
Yes, very significant rights. They can form official committees to represent their interests, they get access to the company's financials, and they negotiate the terms of the reorganization plan. Critically, the plan usually needs to be approved by impaired classes of creditors, which gives certain creditor groups major leverage. There's also the absolute priority rule, which sets a strict pecking order for repayment based on the capital structure. Secured debt first, then unsecured, and so on. It dictates that lower-ranking claimants can't get anything until higher-ranking claims are paid in full. This clear, though rigid structure provides a predictable framework for negotiations and investment. And this focus on rehabilitation and creditor rights is quite different from many insolvency systems elsewhere, say in Europe or Asia, which historically might have been more focused on quick liquidation or had less predictable processes. Plus, the U.S. system offers some distinct advantages for buyers. The Chapter 11 process can let a company get rid of burdensome contracts or liabilities, making the core business more attractive. It allows for a quicker, often less costly way to restructure both operations and finances simultaneously. Investors can also buy specific assets out of the bankruptcy through something called Section 363 sales. These are really attractive because the buyer usually gets the assets free and clear of most old liens, claims, and liabilities, potentially at bargain prices. It offers a clean slate for those assets.
Section 363 sales sound like a powerful way to pick up assets strategically. What about the loan-to-own strategy? The name itself sounds pretty ambitious.
The loan-to-own strategy is a perfect example of a control-oriented distressed investment approach. It involves an investor buying the debt of a distressed company with the explicit long-term goal of converting that debt into equity ownership. Often, the aim is to gain control of the company, typically through the restructuring or bankruptcy process itself.
So you're buying the debt not just hoping it recovers some value, but seeing it as a ticket to eventually owning the company.
Exactly. The initial investment is debt, but the strategic play is to influence the restructuring outcome so that you end up owning the stock of the reorganized company. The sources note that the paperwork for these investments might even be drafted anticipating a future Chapter 11 filing, including clauses designed to strengthen the investor's hand in that scenario. While they want influence, these investors often try to avoid being legally classified as controlling shareholders too early because that can bring extra responsibilities or scrutiny.
Are there specific legal or ethical wrinkles with the loan-to-own approach?
Yes, our sources mention several potential complexities. There could be questions about the company board's fiduciary duties when negotiating with creditors who might become owners. There's the risk that a court could equitably subordinate the investor's debt, basically. Lower its priority if the investor acted improperly or had too cozy a relationship with the company. A court might even recharacterize the debt as equity, treating the initial loan as if it were stock all along, depending on how the deal was structured. There's also the risk of avoidance actions, where payments made to the investor or collateral given to them just before bankruptcy might be challenged and potentially clawed back by the court, depending on timing, valuation, and whether the deals were fair.
Sounds like a legal minefield requiring deep expertise. How do investors actually buy these loan-to-own positions? Is it easy?
Well, they can acquire the securities in a few ways. Sometimes through direct private negotiation with the existing lenders who want out. Sometimes by buying them in the open market, although distressed debt markets can be much less liquid than the stock markets. Or sometimes via a tender offer, where the investor makes a public offer to buy the debt from all existing holders at a set price.
When a company gets into this kind of trouble, does it always end up in a complex restructuring like Chapter 11, or can it just be shut down and sold off?
Well, the fundamental problem is that the total value of all the claims against the company from debt holders, maybe preferred shareholders, maybe even common shareholders, is more than the company's assets and future prospects are currently worth. Often, they're also burning cash. The crucial decision, usually assessed by management, the board, and key creditors, boils down to this: is the estimated value of the company as a reorganized ongoing business greater than the value they'd get by simply selling off all its assets piece by piece in a liquidation?
So if the business is worth more alive and fixed, you restructure. If it's worth more sold for parts, you liquidate.
Broadly speaking, yes. If the projected reorganized value is higher, restructuring is usually preferred because it should maximize the total value available to pay stakeholders. The difference between that reorganized value and the lower liquidation value then becomes the pie that gets negotiated over and divided up among the various claim holders, following their priority and using their leverage. The law, through the absolute priority rule, sets a floor no one should get less than they would in liquidation. This negotiation can be incredibly intense, involving strategic moves or games between different creditor groups. Our sources note that sometimes, even outside of court, senior creditors might agree to take a haircut, less than they're fully owed, to let junior creditors or even equity holders get something if it helps get a deal done faster or cheaper.
And if the liquidation value is higher, or if they just can't agree on a restructuring plan.
If the company is truly worth more dead than alive, or if efforts to agree on a viable reorganization plan fail, then it's typically liquidated, usually under Chapter 7 bankruptcy or sometimes the liquidating Chapter 11 plan. In liquidation, the assets are sold off, and the cash raised is distributed strictly according to that absolute priority rule. Secured creditors get paid first from their collateral proceeds, then various priority claims, like bankruptcy admin costs, some wages, taxes, then the general unsecured creditors. Only if there's anything left, which is rare in deep distress, do preferred and then common shareholders see anything. Common shareholders are almost always wiped out completely in liquidation.
That strict hierarchy seems very clear-cut. Why would traditional banks or other lenders sell these distressed loans to specialists instead of just trying to work them out themselves? They lent the money originally.
For traditional lenders, holding defaulted or non-performing loans is a headache. It requires specialized workout teams, involves significant administrative effort, and importantly, ties up capital inefficiently under banking regulations, demanding high capital reserves. It's often just more efficient for them to sell these claims, even at a big discount, to specialized investors like hedge funds and private equity firms. These specialist funds have the deep expertise in bankruptcy law, like Chapter 11, the analytical horsepower to assess really complex distressed situations, and often the operational experience or network to actually help turn the underlying business around. They're built to extract value from these messy situations in ways that traditional banks, whose main job isn't turnarounds, usually aren't equipped for or don't find capital efficient.
What are the main drivers of returns in distressed debt investing then? Where does the profit, the alpha, actually come from?
Our sources really emphasize that returns often come from buying securities that are genuinely undervalued by the broader market. This undervaluation can happen for several reasons. It might be the sheer difficulty and cost of analyzing companies in deep trouble. It could be the legal complexity of bankruptcy that scares off many investors. Maybe there's a lack of reliable information during the crisis. Or it could just be market overreaction and investors fleeing anything associated with a troubled company or sector. Distressed investors are skilled at cutting through that noise to assess the true underlying asset value or the potential for operational recovery. They often look for companies that have operational problems, maybe bad management, outdated strategy, bloated costs, but still have decent revenue streams or valuable core assets underneath. Their strategy is often about creating value by boosting operational efficiency, fixing the underlying business, not just financial tricks or waiting for the economy to lift all boats. They're looking for companies that need capital, better management, or structural changes that they, as influential creditors or potential future owners, can help push through.
It seems like there's a split in strategies based on how much control the investor actually wants.
Yes, distressed investing generally falls into two broad camps: non-control trading-oriented strategies and control-oriented strategies. Non-control or trading-oriented managers typically invest higher up the food chain, focusing on safer bets like secured debt or senior notes. They usually have a lower risk-reward profile than the control players. They might invest later in the distress cycle, trying to minimize credit risk by being first in line for repayment. It's a more passive, opportunistic style, often more liquid. Returns come from holding these securities and benefiting as value gets unlocked through the bankruptcy negotiations or the company eventually recovers. This is largely the domain of hedge funds and prop desks skilled at deep credit research, buying undervalued public or private debt loans, bonds, convertibles, even bankruptcy claims anticipating a recovery through the formal restructuring. They're value-focused, but not looking to run the company.
Okay, so trading the debt for a recovery, not aiming for the driver's seat. What about the control-oriented strategy?
Control-oriented investors are playing a different game entirely. They invest in the debt of undervalued companies, specifically with the intent of eventually taking control, often by converting their debt into equity ownership through the restructuring or bankruptcy. This is a much more active strategy, definitely higher risk-reward. They're willing to take on more credit risk, maybe investing in junior debt, if that's the path to control. They often act like activists, not just legally but operationally. This style is largely practiced by distressed private equity funds. They accumulate debt specifically to gain control in bankruptcy, and then they actively get involved in making operational and management changes to turn the business around. Some restructuring-focused hedge funds might do this too, sometimes injecting new equity during the reorganization to secure control. They're flexible, looking across the whole capital structure to acquire positions, often at deep discounts, and then using their leverage or position to guide, or even arbitrage, the reorganization process to end up owning the company cheaply.
How exactly do they manage to gain that control during the bankruptcy process? It sounds tricky.
They accumulate strategically important blocks of debt. During Chapter 11, their holdings give them a voice and votes. A key mechanism our sources highlight is gaining influence or outright control by owning a big chunk of the first impaired class of creditors. This is the most senior group of creditors whose claims are not expected to be paid back in full under the proposed plan. Under Chapter 11 rules, a reorganization plan typically needs approval from holders of 2/3 the dollar amount and a simple majority in number of claims within each impaired class to be confirmed. So if an investor owns 2/3 of the claims in that critical first impaired class, they can basically single-handedly vote to approve a plan, driving the outcome. If they own just over 1/3, they get blocking power. They can vote no and reject a plan, forcing more negotiation or maybe pushing the company towards liquidation. This voting power lets them negotiate for equity in the reorganized company in exchange for their debt claims, ultimately taking control. Our sources note this shift in control can sometimes happen quietly through secondary market trading of distressed debt, which is exactly where these sophisticated funds are looking for chances to build these influential stakes under the radar.
That mechanism for gaining control through strategic debt ownership and voting power in bankruptcy is a really specific and powerful insight. What's the typical holding period for these distressed investments? Are they quick flips?
It really depends on the expected timing of the event that resolves the distress, like when a reorganization plan gets confirmed or a key asset is sold. Control investments generally have longer holding periods, often measured in years, because actually turning around a distressed company takes time and effort. Passive trading strategies tied to specific bankruptcy milestones might have shorter time horizons, but still potentially longer than your average stock trade.
Finally, what are the main risks involved in distressed debt investing? It just sounds inherently risky from start to finish.
Oh, it absolutely is, and the risks go way beyond just the company failing operationally. The number one risk is recovery risk. Your investment might simply not recover its value, or you could lose everything if the company liquidates and there's nothing left for your claim level. There's also credit spread widening risk, where the market starts demanding an even higher yield for this type of risky debt, pushing prices down even if the company's specific situation hasn't changed. Mark-to-market volatility can be huge, especially for less liquid claims. Illiquidity is a major issue. Private loans or bankruptcy claims can be very hard to sell quickly if you need to. You face plan execution risk and negotiation risk. The reorganization plan you banked on might not get approved, or the negotiations might end up giving you less than you expected. Legal costs in bankruptcy can be enormous, eating into potential returns. You might face litigation from lower-ranking creditors challenging your claims or the plan. And the bankruptcy claims themselves are often illiquid and usually don't pay interest while the case drags on, meaning your capital is tied up, earning nothing.
So it's not just about analyzing the company, but navigating this incredibly complex legal and financial maze with tons of potential pitfalls. Okay, let's shift gears again to equity market neutral, or EMN. The name itself suggests the goal is to be insulated from the market's ups and downs. How do they try to achieve that?
The main goal of equity market neutral strategies is exactly that: achieve market neutrality. Shield the portfolio from the directional swings of the broader stock market, aiming for zero or near zero beta. They do this by simultaneously holding long positions in some stocks and short positions in others. The idea is that the longs will benefit from certain factors or events, while the shorts will suffer from similar factors or events, canceling out the overall market exposure but leaving behind the specific profit, the alpha, from the relative mispricing between them.
How do they actually find and capitalize on these differences while staying neutral?
These strategies are often highly quantitative. They use sophisticated computer models to identify pairs or baskets of stocks that historically move together, but where a temporary price gap has opened up. They'll go long the stock they expect to outperform and short the one they expect to underperform, betting on their relative performance, and that the price gap will eventually close. That's called mean reversion. Now, to make meaningful money from these often tiny price differences, they typically use substantial leverage. Our sources mention that quantitative EMN funds might use leverage ratios up to 300% long and 300% short. That means their total market exposure, long plus short, could be 6 times their actual capital, even though the net exposure is ideally zero. Discretionary managers usually use less leverage than that, though.
Wow, 300% long and 300% short. That's massive leverage, even if the net market bet is zero. What's the appeal of such a complex, highly leveraged approach?
The value proposition is that EMN strategies aim to deliver returns that are uncorrelated with traditional investments, especially equities. That's particularly valuable when the stock market is flat or declining, where just owning stocks is losing money. By focusing on relative value and hedging out the market risk, they're designed, under normal conditions, to provide stable, less volatile returns. This can potentially reduce the overall volatility of a larger investment portfolio. They're trying to generate alpha purely from idiosyncratic short-term mispricings, not by taking on broad market risk or beta.
But that leverage must introduce some pretty significant risks of its own, right?
Absolutely. The number one risk in EMN is leverage risk. Because they operate with such high gross exposure, even small price moves against them across the portfolio can translate into big losses relative to the fund's capital.
Sure.
If losses hit a certain threshold, the prime brokers who lend them the money in stock can force them to sell positions rapidly to reduce risk. That's a margin call or mandatory de-risking. This is a huge risk for highly leveraged quant managers and can actually make losses worse during market stress, forcing selling at bad prices. There's also tail risk, the potential for really bad performance during extreme market crises. This happens when pairs or baskets of stocks that are supposed to move together suddenly fly apart dramatically, maybe triggering stop losses and forced deleveraging across the whole EMN industry simultaneously.
Given those high leverage limits, I guess these strategies aren't typically available in regular mutual funds.
Correct. Regulatory rules limit the amount of leverage allowed in vehicles like mutual funds. So these highly leveraged EMN strategies are generally found in limited partnerships or other private fund structures, mostly accessible to institutional investors and very high net worth individuals.
Where do EMN funds actually find these opportunities for neutral trading? What kind of mispricings are they looking for?
They're capitalizing on idiosyncratic, short-term mispricings between securities that their models suggest should normally be closely linked or co-integrated, meaning they tend to move in tandem over time. The profit, the alpha, doesn't depend on the market going up or down, but on that temporary divergence and then hopefully the convergence back to the expected relationship. This makes them particularly attractive when the overall market direction is murky or negative.
Our sources list some types of EMN strategies that sound familiar. They overlap with the special situations we talked about earlier.
Yes, there's definitely significant overlap. Both categories are about capitalizing on specific, often niche, price discrepancies. Strategies like stub trading, multi-class trading, and capital structure arbitrage can all be executed within an EMN framework by carefully hedging out the market risk component. The sources also mention pairs trading as a classic EMN approach.
Pairs trading, like the textbook example of betting on Coke versus Pepsi.
Exactly. You're betting on the relative performance of two stocks you expect to track each other closely because of fundamental similarities or market factors. You might go long Coke and short Pepsi if their price ratio strays too far from its historical average, expecting it to snap back. However, the sources point out challenges with simple pairs trading today. The number of truly reliable single pairs might be limited, and the most obvious ones, like Coke Pepsi, probably have most of the arbitrage opportunity already competed away. Just optimizing for historical correlation can also find spurious relationships that look good on paper, but don't actually hold up in the real world. Plus, sometimes very high correlation can actually limit profit potential because the spread variance, how far the prices diverge, might be too small.
So sophisticated EMN managers doing pairs trading probably use more complex methods.
Yes, they might look at multivariate pairs, baskets of stocks versus other baskets, or use more sophisticated statistical filters beyond just simple correlation to find pairs that have better trading characteristics or maybe a clearer reason or catalyst for why they should converge.
How do EMN strategies typically fit into a bigger investment portfolio? What role do they play?
They're often considered as alternatives or supplements to traditional fixed income allocations, especially when bond yields are very low or the yield curve is flat, making bonds less attractive. Even with the leverage and tail risk, EMN strategies are seeking a type of alpha, a source of return, that's distinct from both stock market risk and interest rate risk. The goal is diversification and adding a different return stream to the mix.
And their overall risk profile, just to summarize.
Under normal conditions, they generally aim for modest returns, market neutrality, and low volatility. They offer high diversification compared to strategies betting on market direction, and often have decent liquidity, depending on how they're implemented. They are predominantly quantitative, focused on shorter time horizons, and betting on mean reversion.
Okay, moving on. Convertible arbitrage. This involves convertible bonds you can convert into stock. How does this work as an event-driven strategy?
Right. Convertible arbitrage involves hedge trades using these convertible bonds. A convertible bond is a hybrid. It's part bond, giving you interest payments and principal back, and part equity option, giving you the right to convert the bond into a set number of shares of the company's stock. The typical strategy involves buying the convertible bond while simultaneously shorting the underlying common stock of the same company.
So you're hedging out the stock market part of the convertible.
Exactly. The short stock position hedges the equity sensitivity, the delta of the convertible bond. What the arbitrager is essentially trying to do is isolate and trade the other components of the convertible's value. That includes its value purely as a bond, which relates to the company's credit risk, its sensitivity to interest rates, and very importantly, the value of that embedded option to convert into stock, plus any other special features it might have.
How does market volatility play into this strategy?
Generally speaking, higher volatility in the underlying stock price is good news for convertible arbitrage strategies, assuming other things stay equal. Increased volatility makes that embedded equity conversion option theoretically more valuable. Higher volatility also tends to create more frequent and larger temporary price gaps between the convertible bond and the underlying stock, which just expands the set of opportunities for ARBs to exploit.
What drives the returns here beyond just that basic delta hedge? Is it more complex?
Yes. Returns often come from exploiting those temporary mispricings based on more subtle factors, or capturing the yield from the bond that's hopefully higher than the cost of borrowing the stock for the short position. And importantly, Returns are often driven by issuer-specific events. For example, maybe the company gets acquired. The legal document governing the bond, the indenture, might have special takeover protection clauses that benefit bondholders if that happens. Or maybe the company announces it wants to exchange its outstanding convertible debt for new securities, creating a specific event opportunity. Our sources also mention things like net share settlement features in newer convertibles. These are good for the issuing company's accounting. They show less dilution on reported earnings, which can influence how companies behave and create trading nuances.
So it's not just plugging numbers into a formula. You really need to read the fine print in the bond documents and watch for corporate actions.
Precisely. Our sources really stress that making money in convertible arb often goes way beyond what you might call pure arbitrage, based just on delta hedging. The strategy involves a variety of complex hedge trades that need deep fundamental analysis, not just assessing the company's credit risk, the bond part, but also analyzing the stock's volatility characteristics and understanding the specific terms of that bond indenture inside out. Plus, sometimes opportunities arise from direct negotiation with the company itself. These more complex, event-driven aspects often have limited capacity. You can't put billions to work easily, which acts as a barrier to entry for really large, less specialized funds.
Can you give us a specific example of how an event affected convertible bonds?
The takeover of BAA, the UK airport operator, by Grupo Ferrovial back in 2006 is a good case study. Ferrovial made a cash offer to buy BAA. Now, BAA happened to have convertible bonds outstanding, and critically, these bonds had specific takeover protection clauses written into their indentures.
Takeover protection in a bond document. What did that actually mean for investors holding those bonds during the takeover?
It meant that if BAA was acquired, the terms under which bondholders could convert their bonds into shares, or maybe get paid out, would become more favorable, or be adjusted specifically because of the change of control. Many arbitrageurs, knowing about this clause, bought the convertible bonds after Ferrovial's offer was announced. They anticipated that the value of these bonds would rise because of this built-in protection and the potential for a payout linked to the cash-off price for the stock.
But the deal wasn't simple, was it? I remember it being quite contentious.
Far from simple. The acquisition faced major regulatory review by UK authorities concerned about BAA's airport monopoly. That threw considerable uncertainty into the deal's probability and timing, which definitely affected the price of the convertible bonds. On top of that, Ferrovial actually revised its offer price upward several times during the bidding process. So you had these factors: regulatory risk, changing offer prices, interacting directly with the specific terms of the convertible bonds. As the underlying stock offer price went up with Ferrovial's revisions, the value of the convertibles kind of ratcheted higher in response, creating very dynamic opportunities and risks for those trading the convertibles based on those specific terms and the unfolding events.
That example really highlights how the nitty-gritty details of the bond contract, combined with regulatory twists and deal negotiations, create the complex playing field for convertible arbitrage. What's the general outlook for the convertible arb market these days?
Our sources suggest that a pickup in new issuance of convertible bonds by companies, combined with relatively stable or favorable volatility expectations in the market, generally creates a better environment, a larger opportunity set for the strategy.
Okay, we've talked about events tied to companies, their financing, market mechanics. There's another category mentioned that capitalizes on differences not in companies, but in the rules themselves. Regulatory arbitrage.
Right. Regulatory arbitrage is a related concept, but it's focused on exploiting loopholes, inconsistencies, or just differences within regulatory systems or between different countries or jurisdictions. The goal is to structure your business activities or transactions in a way that lets you avoid burdensome rules or benefit from more favorable ones compared to what would normally apply. It's often perfectly legal because you're just using the existing rules, but it can sometimes be seen as unethical if it seems to undermine the intended purpose or spirit of those regulations.
How do companies or investors actually do this?
It often involves complex deal structuring, sophisticated financial engineering, or strategically locating activities, or incorporating entities across borders in places with rules that are less strict, less costly, or just better suited for a particular purpose.
Like using tax havens. That's the classic example, right?
That's a prime and widely discussed example, yes. Setting up companies or subsidiaries in places known as tax havens lets companies minimize their tax bills. For instance, registering a subsidiary in, say, the Cayman Islands might just involve paying a small licensing fee with no corporate tax on profits earned outside the Caymans. Even within the U.S., states like Delaware offer favorable tax and regulatory environments that attract corporations. While they don't eliminate federal taxes, they offer perks like no state sales tax and no corporate income tax on business conducted outside Delaware, letting companies incorporate there without actually having their main operations there.
So it's about legally finding the most advantageous set of rules available and positioning yourself under them.
Yes, that's the core idea. The financial industry has historically done this too, sometimes using complex cross-border structures or acquisitions to place certain activities under regulators perceived as less demanding than others. Our sources also mention specific transaction examples, like Blackstone's IPO back in 2007. By structuring their public offering as a master limited partnership, MLP, instead of a traditional corporation, Blackstone was able to sidestep certain corporate tax rates. This was described as effectively exploiting a regulatory arbitrage between how different types of entities were defined and taxed under the law versus their underlying economic substance.
Can these kinds of regulatory arbitrage plays be completely stopped?
It's very hard to eliminate entirely because it often relies on finding and exploiting subtle gaps or interactions within really complex legal and regulatory frameworks. However, regulators can try to limit it by identifying and closing specific loopholes when they become obvious, and by working harder to coordinate and enforce rules across different jurisdictions and borders.
And you mentioned there's an ethical debate around this.
There is. Critics argue that even if it's technically legal, regulatory arbitrage can undermine the intended goals of laws, whether they're about taxes, environmental protection, or financial stability. It can potentially lead to a race to the bottom, where jurisdictions compete by lowering standards, which could have negative consequences overall. For example, exploiting lax anti-money laundering rules in one place could make it easier for illicit activities to happen globally.
That makes sense. You're benefiting from weaknesses in the system that might harm others. Finally, our sources dig into a really distinct area that uses the legal system itself as the event. Third-party litigation funding, or TPLF. This seems relatively newer compared to the other strategies and sounds like it could be quite disruptive.
It is a significant and rapidly growing area, yes. TPLF involves investors, and these are increasingly sophisticated players, like hedge funds, asset managers, dedicated litigation finance funds, providing non-recourse financing for lawsuits. They front the money needed for legal expenses, court costs, expert witnesses, sometimes even living expenses for the plaintiffs. In return, they get a contracted share of any settlement or judgment money that's eventually recovered if the case is successful. The crucial part is that it's non-recourse. If the case loses, the investor gets nothing back. They bear the financial risk.
So investors are literally placing bets on the outcome of lawsuits, treating litigation like an asset class.
That's exactly right. They analyze the merits of a case, the potential damages, the likelihood of success, and decide whether to invest, hoping for a return that's uncorrelated with traditional markets. This happens across all sorts of legal disputes, large-scale mass torts, like big product liability cases, complex commercial fights between companies, intellectual property battles, you name it.
And our sources suggest this is fundamentally changing the U.S. civil justice system, maybe without most people realizing it.
Profoundly changing it, according to the experts cited. As one put it quite bluntly, litigation funders are reshaping every aspect of the litigation process, which cases get brought, how long they are pursued, when they are settled, who is behind them. But the critical point the sources hammer home is that this major transformation is happening largely without transparency. Another expert stated, we have one of the three branches of government, the judiciary, that's really being quietly transformed by this influx of external capital.
Quietly transformed, that phrase definitely captures the concern about the lack of transparency. What's the main argument for TPLF according to its proponents?
The primary argument in favor, as cited in the sources, is that it improves access to justice. It gives individuals or small businesses who might have legitimate claims but lack the money, the financial means to actually pursue those claims against well-funded opponents, often big corporations. Without funding, they might have been forced to drop the case or settle for much less.
That seems like a clear potential positive, leveling the playing field in some cases. But the sources list a whole host of criticisms and potential negative impacts.
Yes, many are cited. Critics argue that bringing in a third party with a direct financial stake can potentially compromise a lawyer's ethical duties to their actual client, creating conflicts of interest. A major criticism highlighted repeatedly is that TPLF contributes to and even fuels the mass filing of speculative or sometimes downright unsupported tort claims.
How does funding encourage potentially weak or meritless claims?
By dramatically reducing or even eliminating the financial downside risk for both the claimant and sometimes the law firm handling the case. If the case fails, the funder eats the loss, not the plaintiff or the law firm that would otherwise have paid the expenses. One expert described the psychological effect on funded law firms as being like gambling with house money. They can pursue riskier, more complex, maybe less certain claims without putting their own capital on the line up front. They trade the certainty of spending their own money now for the possibility of a big payout later, only if they win. Funders can afford to finance this because they typically diversify their investments across a large portfolio of different cases and investors. So the failure of any one case doesn't hurt them nearly as much as it would an individual plaintiff or a small law firm.
So even if the chance of winning any single case is low, it becomes a viable investment if the potential payout is huge and the funder spreads the risk across many such bets.
It's exactly. Yeah. It allows for a portfolio approach to litigation risk, which is fundamentally different from how litigation was traditionally financed. As one judge quoted in the sources worried, "I don't believe our courts are casinos where people should just go to profit. That's bad for the system, and I think it undermines the importance of our courts." Other criticisms include the argument that TPLF can drag out litigation and make settlements harder or more expensive. The funder becomes another stakeholder behind the table in settlement talks. They often need a substantial return. Sources mention funders typically aiming for 2x or 3x their investment back, which might make them push for a higher settlement than the plaintiff might otherwise accept or reject reasonable offers. Critics also worry that TPLF undermines U.S. companies that are frequent targets of large-scale litigation, and that it could potentially create avenues for stealing trade secrets or sensitive corporate information if funders get access to discovery documents during the lawsuit.
And what about the impact on the actual plaintiff, the person who was supposedly harmed in the first place?
This is a huge point of concern raised in the sources. Critics argue TPLF can reduce the plaintiff's control over their own case and settlement decisions. The funding agreement might give the funder contractual rights that influence strategic choices or even settlement authority. Funders might also exert pressure by threatening to pull funding if the case isn't proceeding the way they want, which could effectively coerce a plaintiff or law firm. The sources also highlight a really troubling lack of transparency sometimes, not just to the court or the opposing side, but even to the plaintiffs themselves about the existence or terms of the funding. There are concerns that plaintiffs might end up receiving only a tiny fraction of a settlement or award because huge amounts are taken out for interest and fees related to funding they weren't even aware of or didn't fully understand.
That's genuinely concerning, the injured person potentially getting pennies on the dollar because of hidden funding costs.
Yeah.
You mentioned aggressive marketing earlier. How does that connect?
Sources describe how aggressive ad campaigns recruit potential claimants, often for mass torts targeting specific products or drugs. Then these potential claims are sometimes packaged up and sold to law firms, maybe with funding already attached. Funders and lawyers understand that if you can link a widely used product to a common illness, even if the scientific connection is weak or debatable, you can generate enough cases and pressure on a large corporate defendant that they might settle just to avoid the massive costs and risk of unpredictable jury verdicts, even if most individual claims are weak. This strategy can lead to huge payouts for the lawyers and their funders, sometimes irrespective of the scientific merits.
The sources provide some actual data suggesting this dynamic is playing out, especially in U.S. federal courts through something called multi-district litigations, or MDLs.
They do. Funded mass tort cases, especially product liability ones, are increasingly funneled into these federal MDLs. It's a way to handle thousands of similar cases efficiently by consolidating pretrial proceedings before one judge. The data cited is pretty stark. MDL cases now make up a huge and rapidly growing chunk of the entire federal civil caseload. By the end of fiscal year 2023, MDLs accounted for over 71% of all pending federal civil cases. That's up dramatically from around 29% just 12 years earlier. It suggests this specific type of aggregated litigation, which often relies heavily on funding models, is really dominating the federal courts.
And is there evidence within these MDLs that supports the claim that funding fuels unsupported cases?
Yes, the sources cite specific examples and data suggesting tens of thousands of potentially unsupported claims have shown up in some large MDLs. These are cases where later review indicated the claimant never actually used the product, didn't suffer the alleged injury, or their claim was filed too late, barred by the statute of limitations. Examples given include MDLs related to products like the Mentor Sling, where 75% of cases were reportedly dismissed eventually. Ethicon pelvic repair products, 53% dismissed. Zofran, around 40% dismissed. And Cymbalta, 31% dismissed. Judges overseeing these MDLs have reportedly commented that the MDL structure, while efficient, can inadvertently attract cases that might not have survived on their own or would have been weeded out much faster. This flood of potentially weak cases can clog the courts, mess up the process of using sample trials, bellwethers to gauge case values, and make it harder to figure out fair settlements.
So the portfolio nature of TPLF means even flimsy cases can be profitable bets within an MDL, because just a few huge outlier verdicts can pay for thousands of failed cases.
That's exactly the argument critics make, and they point to examples like the Roundup weed killer litigation against Bayer-Monsanto. Even though Bayer reportedly won about 2/3 of the individual cases that went to trial, there were still several massive plaintiff verdicts with enormous headline numbers. Similarly, Johnson & Johnson reportedly won 95% of the talc ovarian cancer cases tried by mid-2024, but one single verdict awarded over $2 billion to just 24 plaintiffs. For a funder managing a portfolio, the possibility of even one low-probability outlier win like that can justify funding a vast number of weaker cases, knowing many will fail if the potential upside on the winners is astronomical.
This lack of transparency, the potential influence, the impact on the courts and plaintiffs, it all seems to be driving calls for more openness. Is there a push for mandatory disclosure of these TPLF agreements?
Absolutely. There are definitely growing calls for mandatory disclosure of TPLF agreements during litigation based on all these concerns about transparency and fairness.
Why do proponents think mandatory disclosure is so important?
For several key reasons highlighted in the sources. First, disclosure allows courts and all the parties involved to assess potential bias or conflicts of interest that the funder's presence might create. This is critical for judges who might need to recuse themselves if they have a financial link to the funder, or for parties evaluating if a witness paid by the funder might be biased. Disclosure is also argued to be important for decisions about shifting legal costs or imposing sanctions if a funded party or their lawyer acts improperly during the case. Fundamentally, proponents argue it's just necessary for basic transparency and maintaining the integrity of the justice system, especially given how influential TPLF is becoming.
What's the current situation with disclosure rules in the U.S.? Is it required everywhere?
It's currently a real patchwork, but the trend seems to be moving towards requiring more disclosure. Some federal courts, at both the district level and in certain circuits, have put local rules in place requiring parties to at least disclose the identity of any litigation funder to the court, mainly so judges can check for conflicts. A growing number of U.S. states have enacted or are considering laws that mandate broader disclosure of the TPLF agreements themselves, potentially including the terms and amount of funding. Montana passed a law in 2023 requiring disclosure to all parties, the court, and even insurers. Indiana, West Virginia, and Louisiana also have state laws requiring some form of disclosure. And the National Council of Insurance Legislators has adopted model legislation recommending mandatory disclosure.
So while it's not universal yet, the tide seems to be turning towards requiring disclosure. What are the arguments usually made against mandatory disclosure? Why the resistance?
Well, while the sources don't lay out a neat list of counterarguments, the implicit position from those opposing disclosure, based on the context, is often that the TPLF agreement is a private, confidential business contract between the funder, the law firm, and maybe the client. They argue the terms of this financial deal are proprietary business information. They contend this financial relationship is generally irrelevant to the actual merits of the underlying legal case, and that forcing disclosure could put the funded party at a strategic disadvantage in the litigation.
Interesting. So the debate really boils down to balancing the privacy of business contracts against principles of transparency and fairness within the court system.
Exactly. And given how fast TPLF is growing and how much impact it's having, that debate is becoming increasingly central to discussions about the future shape of civil litigation in the U.S.
So we've covered a really complex landscape today. We've gone from investors proactively shaking up companies as activists to those making precise bets on corporate marriages in merger arb, finding hidden value in the messy world of bankruptcy, exploiting tiny price gaps across markets in special situations and EMN, tapping into the dynamics of how companies raise money, benefiting from differences in regulations, and even effectively investing in the outcome of lawsuits. These aren't just abstract ideas, they are sophisticated strategies used by savvy investors, often hedge funds, who rely on deep analysis and unique insights into specific events and situations. Their goal often is to generate returns that don't just follow the broader market, finding opportunities others miss by digging beneath the surface.
The key takeaway, I think, is really the incredible variety and complexity in how finance and sophisticated capital try to profit from these discrete corporate, legal, structural, and even regulatory events. It just underscores how many layers there are to market dynamics and how value can be created or maybe extracted through these highly specialized approaches. It fundamentally highlights the critical importance of catalysts and getting the timing right in these kinds of investment strategies.
And that leaves us with a thought to chew on. As markets, technology, regulations just keep evolving relentlessly, what completely new kinds of events might become the next focus for arbitrage opportunities? Will litigation funding continue its explosive growth and reshape the legal system even more fundamentally? Or will increasing transparency and regulation alter its path? And maybe most fundamentally, in a world that's increasingly connected, with data flowing faster than ever, how will sophisticated investors continue to find these differentiated sources of alpha that rely on unique insights into specific outcomes?
Indeed, that constant search for a distinct informational edge or a structural advantage based on predicting and capitalizing on specific events, that's a perpetual motion machine in financial markets.
Definitely something to think about long after this deep dive wraps up. Thanks for exploring this complex world with us today.
My pleasure. Always fascinating stuff.
We'll catch you on the next Deep Dive.